Eurozone retail trade remains stable in October. COMESA FDI soars 154% to $65 billion in 2024. And U.S. unemployment benefits fall to a more than 3-year low. Welcome to our economic bulletin. We start off with Europe, where the Eurostat estimates have shown that seasonally adjusted retail trade in the Eurozone remained stable in October after modest growth of 0.1% and 0.2% in September. In the euro area, food, drinks and tobacco rose 0.3%, non-food products fell 0.2% and automotive fuel increased 0.3% in the EU. The figures were 0.4%, minus 0.2% and 0.5% respectively. Compared with October 2024, retail trade grew across all sectors, with the euro area up 0.9% for food, drinks and tobacco, 2.1% for non-food products and 1.8% for automotive fuel, while the EU saw increases of 0.5%, 2.4% and 2.6%. The Bank of England has announced that it is launching a stress test to assess how the $16 trillion global private equity and private credit sectors would withstand a major financial shock. The bank noted that the system-wide exploratory scenario will culminate in a final report in early 2027, focusing on the potential impact of the broader UK economy rather than identifying vulnerabilities at individual firms. It added that participating firms account for roughly 1/3 of Britain's private equity leverage buyout activity, half of private credit in the United Kingdom corporate sector, and 40% of employment in private equity-backed businesses. The Bank of England has reported that British businesses plan to reduce staff while rising prices at roughly the same rate as before, based on a survey of over 2,000 firms conducted ahead of Finance Minister Rachel Reeves' annual budget. Firms expected to increase prices by 3.7% over the next 12 months, slightly higher than the 3.6% anticipated a month earlier. Employment expectations weakened, dropping 0.1% points to minus 0.2% for the year ahead. Companies' forecast for consumer price inflation remained steady at 3.4% in November, while expected wage growth edged up to 3.8%, 0.1% points higher than in the previous 3 months. Still in Europe, Spain's economy minister, Carlos Queiroz, has announced that the country plans to use only about a quarter of the European Union's pandemic recovery loans, as its fast-growing economy can raise debt without EU restrictions. He added that financially there is no advantage in taking the loan, since Spain can finance itself through its own debt issuance. Crepo noted that while Spain has largely avoided the direct impact of US tariff on the EU, the government is still working to diversify trade and investment. He also highlighted that direct transfers have been a priority to support sectors such as green energy, and that only around 25% of the available loans may ultimately be used.
From our side, we will keep this investment push, but then luckily.
Hungary's Prime Minister Viktor Orban has announced an 11% hike in the minimum wage of 2026 after employers and employees reached a deal despite an economic stagnation that has forced his government to slash growth forecasts for this year and next. Orban noted that the minimum wage would rise to 22,800 forints per month, while the minimum wage for skilled workers will increase 7% to 373,200 forints. On Franco-Chinese relations, French President Emmanuel Macron has called for a more equal economic relationship between China and Europe during a joint press conference with his Chinese counterpart, Xi Jinping. He noted that Europe and China have a role to play in laying the foundations for fair and robust global economic governance based on rules and not the law of the strongest. Macron noted that the imbalances that are accumulating today are unsustainable, adding that they pose a risk of financial crises.
Et dans ce cadre, nous souhaitons travailler dans un esprit positif avec la Chine sur la base d'une relation.
Ministry of Commerce spokesman He Yadong has reported that trade between China and France rose 4.1% year-on-year to $68.8 billion from January to October. He noted that the two-way investment increased steadily and exceeded $27 billion. Yadong noted that Chinese and French authorities signed a memorandum of understanding on strengthening two-way investment. The authorities also pledged to provide a fair, non-discriminatory and predictable business environment for enterprises from both countries. Moving on to Africa, Bank of America Global Research has stated that an external debt restructuring in Senegal is increasingly likely in H2 2026, with a moratorium and restructuring talks expected by year-end due to the resilience of the local market. BOFA added that while strong regional debt markets could allow Senegal to avoid IMF support temporarily, this would likely become unsustainable by late 2026. Meeting 2026 financing needs would require raising 40% more than in 2025, deemed unrealistically, while likely recovery value is estimated at $40 per $100 of pre-restructuring phase value. The bank also noted Senegal has $750 million to $1 billion in total return swaps backed by the 1.3 to 1.5 times domestic debt collateral, which can trigger accelerated repayment. The common market for Eastern and Southern Africa has reported a record surge in foreign direct investment in 2024, with inflows rising 154% to $65 billion, driven largely by Egypt's landmark Ras Al Hikma development. FDI into other COMESA countries also grew 16%, reflecting strengthening investor confidence across the region. COMESA's shares of global FDI doubled from 2% to 4%, while its share of flows to developing countries rose from 3% to 7%, accounting for 67% of Africa's total FDI. However, the report noted that FDI remains concentrated in a few countries, with Egypt, Ethiopia, Uganda, and the Democratic Republic of Congo and Kenya attracting 90% of total inflows. Intra-COMESA investments also remained limited, accounting for just 3% of projects and 6% of their value.
The head of state and the government illegal to reinforce the mandate.
The COMESA investment report has also highlighted a major increase in international project finance, which nearly doubled to $79 billion, representing 4/5 of all IPF activity in Africa. This growth was driven by large-scale renewable energy, power grid and infrastructure projects in Egypt, Tunisia, Rwanda and Malawi. Greenfield investment remained strong as well, with announced projects worth $77 billion, the second highest level in COMESA's history, representing 2/3 of Africa's total greenfield investment value. For further analysis, we're joined from Seville by Director of EU ASEAN Center and former advisor to the World Bank, Meher Nicolas Frizilli. Welcome, sir, to Qnews, and always a pleasure to have you with us in our interviews.
My pleasure.
Sir, how does the 154% surge in foreign direct investment into COMESA in 2024, especially driven by Egypt's Ras Al Hikma development, reflect investor confidence in the region's economic prospects?
I think, whichever way, however you look at it, these are amazing figures. Even if we rebase, what do I mean by rebase? I mean that, Egypt is almost too big because, compared to the average size. Let's not forget, COMESA includes some tiny countries like Mauritius or Eritrea. So basically, Egypt is almost too big, right? So we have to rebase. What do I mean by rebase? We do a statistical treatment to reduce a little bit the relative size of Egypt. So, what I'm coming at, even if we rebase, if we say, okay, Egypt is too strong or too big, let's diminish a little bit the figure to adjust, to have more adjusted figures. Even then, the growth, the annual growth is amazing. So bravo, COMESA. It is a big success. It's only the beginning. But
is it a big success for COMESA or Egypt, yes, sir?
Both. So both. And what we look at here is the trend, because, these are 10, 15, 20 years investment cycles. A lot of these money, as you know, is going into infrastructure, energy infrastructure, transportation infrastructure, real estate. So these are long-term projects. So 1 year is not enough to judge. But still, even if we rebase and adjust the figures, it's very promising. One more thing I'd like to say. The data, so the data coming from the UN and from COMESA itself is very slow. So what we got yesterday and today are the figures from 10 or 11 months ago, if you see what I mean. But still, all that being said, it's great. Why is it great? Because it shows a very positive trend line. So, let's focus on FDI, foreign direct investment. The world entered a new era, the age of geoeconomics. The rivalry, the giant rivalry pitting China against America for financial industrial supremacy. So in that age of geoeconomics, things are accelerating. And for countries like Congo, like Egypt, like Kenya, like Zambia, it's a matter of survival. Economic growth is a matter of survival, and foreign direct investment, FDI, is the main fuel of economic growth for emerging markets. So the news are great because, COMESA's share of, global foreign direct investment, including rich countries, including China and America and Europe, their share went from 2% to 3% in just 1 year. That's a 50% rise. That is impressive. But even more impressive, in my opinion, focusing on EMDEs, emerging markets and developing economies worldwide.
Could you give me an example of emerging markets, sir?
Yes, so if we look at, more precisely at EMDEs, Latin America, Middle East, Africa, and Asia, right? It's even more impressive because COMESA's share...
That was what you meant when you said be-based.
Yeah, yes, exactly. In part. So COMESA's share of foreign direct investment inside the emerging markets family, it went up from 3% to 6% if we rebase, right? So if we diminish Egypt a little bit to rebase, it went from 3% to 5.5 or 6% in just 1 year. And that is very impressive, very, very impressive. And that's two-thirds, it's two-thirds or 60% of foreign direct investment in the whole of the African continent. So that's also impressive. Another way of looking at it, many of the COMESA member states are former British and French colonies. And for many years, for 50, 60 years after independence, the biggest investors in that part of the world were still dominated by British and French companies. They have collapsed completely in the past 2 or 3 years. And who are now the dominant investors, the dominant foreign direct investors into Egypt, Kenya, Congo, and Mozambique, etc.
Sir, perfect. What role has Egypt's Ras Al Hikma project play in transforming COMESA's investment landscape and attracting unprecedented FDI levels?
An amazing role. First, the size, right? So that, the size of it is like 10 or 20 times more than the average big, quote unquote, FDI project in, let's say, the Republic of Congo or Mauritius or Kenya. So size matter, but more than size, it is the nature and the geography of the investors. So those who have put money into that gigantic Egyptian project, where do they come from? They come from Abu Dhabi. They come from Saudi Arabia, Qatar, China, but also from America and Europe. So Egypt was able to attract money from these countries. And here the key word is economic attractiveness. Why is it important? The power of attraction. Because when you speak to big investors, and who are they? They are the big sovereign funds from Asia, Saudi Arabia, Abu Dhabi, or the big pension funds, like the big pension funds from Canada, Australia, and America. These are the world's biggest investors. And when you say to them, but why don't you invest? Why don't you invest more in Egypt or Ethiopia or South Africa? They always tell you, we can't. It is too risky because of country risk, right? It's illiquid, it's risky. And if you have a strong economic attractiveness, it means that you can convince these big pension funds and sovereign funds from Montreal, New York, and Abu Dhabi to put money in African projects, because let's not forget project. It's not like buying a share on the stock market, right? You're investing trillions of dollars into highways, airports, ports, mines, transportation. So these are money where you commit to invest in a country for 10, 15, 20 years. It's a vote of confidence in Egypt. It's a vote of confidence in the future of the Egyptian and East African economy, and that's great.
Sir, considering that Egypt, Uganda, Democratic Republic of Congo, and Kenya attracted 90% of FDI, what challenges and opportunities does the concentration of investment present for the broader COMESA region?
Well, here, there are some challenges which will never be surmounted for obvious reasons, because if you are Mauritius, you are a small island state, right? If you are Eritrea, you are a tiny dot on the map. So, of course, Eritrea or Mauritius will never be able to compete with Egypt. Also, there are countries which are now going out of very bloody civil wars or are still in a state of war. And I'm thinking here of Congo, right? So it's difficult for a country like Congo, for example, where 10% of its national territory, you have war, you have cities burning. It's difficult to tell investors, come and invest in Congo when 10% of the country is subject to riots and war. But, all that being said, I think in the future, there will be a broadening, even Libya and Congo, they will be able to attract foreign direct investment. And here, the key word is anchor.
Libya, sir, in light of the political instability that's in the country, it will still attract investments?
Yes, it will take time, but yes. And here the key word is
anchor. So you don't mean today or this year, you mean in the future?
Yes, and you need an anchor. In the storm, when you have a boat in the ocean and there's a big storm, to reassure the sailors on the boat, you need to have a strong anchor. And I think, countries like Egypt can act as anchor investors, because if Egypt invests in a project in Libya and Sudan, it can then tell the people in Abu Dhabi or Montreal or New York, look, we, the Egyptians, are taking that risk because we are locals. We understand what's happening in Sudan and Libya. Come and invest alongside the Egyptian sovereign fund and the Egyptian insurance companies, etc. So I think it's a beautiful, beautiful thing to have a strong local African-Arabian anchor investor.
The report highlights a significant rise in international project finance and greenfield investment, especially in renewable energy and infrastructure. How might these investments reshape COMESA's economic development over medium-term strategic plan 2026-2030, sir?
It's great. It's great because I would say at long last, the Americans and the Europeans are waking up. What do I mean by that? That there's an old Roman proverb which goes like this, natura abhorrent vacuum. Nature hates emptiness.
Could you say it again, sir?
Natura abhorrent vacuum, like a vacuum cleaner, which means nature doesn't like emptiness. And what do I mean by that? Like for many years, China became the biggest investor in East Africa by far because there was American and European emptiness, because the Europeans and the Americans, they retracted because the Arabian Gulf sovereign funds were not present enough. That was empty. And in that emptiness, China entered. And China became the biggest investors in East African mines, including for rare earth minerals, uranium, oil and gas, transportation, rail, and airports. And at last, the West woke up and they realized that they would need to enter the emptiness. Otherwise, it would all fall into China's hand. What is great for Egypt and what is great for Africa today is that there is competition between the West and China. And
sir, given the mixed trends and investments towards sustainable development goals sectors, how can COMESA leverage projects like Ras Al Hikmah to better balance economic growth with social and environmental objectives, sir?
Well, here clearly, Egypt is like a big brother or big sister, right? So Egypt is playing an exemplary role. So if you have a small child, the small child looks up to his older brother for example. And really what Egypt has done under the presidency of Sisi is amazing. Egypt has embraced the SDG agenda, so Sustainable Development Goals. Egypt was actually one of the first countries in the world, and I'm saying not only the government, but also banks, also insurance company, across the board. Egypt embraced the UN Sustainable Development Goal early on, and I think, if you look at all these projects in Egypt, they all have, sustainability guidelines. They all take into account, what we call SDG 5, which is women's empowerment. So there's no project being built now in Egypt if you don't have at least a third or 40% of women engineers, women professionals, women technicians. It's amazing because it sets a high bar and it sets a good example, and the neighbors, the Sudanese, the Congolese, the Ethiopians, can then emulate that model.
Even in the parliament, sir, we have to have a lot of women. From Seville, that was director of EU ASEAN Center and former advisor to the World Bank, Meher Nicolas Verzilli, our distinguished guest. And thank you very much for your valuable insights and for your informative and intellectual knowledge, sir, and most importantly, your time. Back to our news and moving to the United States, the Labor Department has reported that new applications for U.S. unemployment benefits fell to a more than 3-year low last week, signaling continued strength in the labor market. Initial claims dropped 27,000 to a seasonally adjusted 191,000 from the week ending November 29, the lowest level since September 2022. Meanwhile, continuing claims, those received benefits beyond the first week fell 4,000 to 1,939 million for the week ending November 22, suggesting steady hiring. Despite this, the unemployment rate edged up to 4.4% in September from 4.3% in August. Commerce Ministry spokesman He Yang-dong has announced that China is working on streamlining rare earth export licenses, adding that the government carries out export controls on rare earth elements in accordance with laws and regulations. Yang-dong noted that all compliant export applications for civilian use has been approved promptly. He added that the government was introducing measures like general licenses to ease business operations and ensure compliance, helping protect the global supply chain stability. Yang-dong, however, did not say if new licenses had been issued. Oil prices were steady on Thursday, with the market focused on Ukraine's attacks on Russian oil assets, while stalled peace talks tempered expectations of a deal restoring Russian oil flows. Brent crude rose 35 cents or 6.0% to $63.02, while U.S. West Texas Intermediate rose 41 cents or 7.7% to $59.36. Gold prices were largely unchanged on Thursday as rising U.S. Treasury yields offset support from a weaker dollar, while markets awaited Friday's U.S. inflation data for clues on the Federal Reserve's policy outlook ahead of its December meeting. Spot gold was up 0.1% to $4,211.19 per ounce. U.S. gold futures for February delivered rose 0.3% at $4,243.70 per ounce. Meanwhile, silver fell 2.5% to $56.99 after touching a record high of $58.98 on Wednesday. The metal is up about 97% this year, supported by a structural support deficit, concerns around market liquidity, and its inclusion in the United States critical minerals list. And moving on to global stock markets, which have shown mixed performances on Thursday, with European indices showing broad gains. In the United States, the Nasdaq inched up 0.02%, while the S&P 500 declined 0.01%. The Dow Jones Industrial Average slipped 0.07%. In Europe, Germany's DAX increased 0.92%, France CAC 40 gained 0.60%, and Britain's FTSE 100 jumped 0.34%. Across Asia, Japan's Nikkei 225 surged 2.33%. Hong Kong's Hang Seng Index hiked 0.68%, while China's Shanghai Composite fell 0.56%. That brings us to the end of our economic bulletin. Here's what we have been covering. Eurozone retail trade remains stable in October. COMESA FDI soars 154% to $65 billion in 2024. And the United States unemployment benefits fall to a more than 3-year low. This concludes our economic bulletin. Don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at QNewsEG to stay informed. Thank you very much for watching, and stay tuned for more updates on Qnews. Thank you very much. I'm Rana Khustas.